Welcome to the last webcast on the discussion paper Financial Instruments with Characteristics of Equity, or FICE for short. My name is Kumar Dasgupta, Technical Director at the ISB. Today, I'm joined by Choi, Technical Manager at the ISB. Before we start, a few housekeeping points. You can download the slides by clicking on the link below the slides window. This webcast is a recording, so we are unable to take any questions from the audience today. Lastly, the views expressed are those of the presenters, not necessarily those of the board or the IFRS Foundation. For those of you who have been following the webcasts, you will know this is the sixth in the series covering the FICE discussion paper. In fact, this is the final one in the scheduled series of FICE webcasts. In previous webcasts, we have discussed the board's preferred approach to classification and presentation of equity instruments. Today, we will talk through presentation of financial liabilities, which is covered in section 6 of the discussion paper. Classification of financial instruments as liabilities or equity is a binary distinction, and for a variety of financial instruments with different features, it can only convey so much information. To help provide information that is not provided by classification, the board's preferred approach involves enhanced presentation and disclosure requirements. In particular, for some financial liabilities, the discussion paper explores the separate presentation requirements. So which financial liabilities are we looking at then? As you will recall, the board's preferred approach classifies a financial instrument based on two features, the timing and the amount feature. A financial instrument would be classified as a financial liability if it has either one or both features of a financial liability. This means some financial instruments would be classified as financial liabilities even if they have the amount feature of an equity instrument. For example, let's consider instrument X issued by Company A. Instrument X requires Company A to make a cash payment in 5 years' time for the fair value of 100 owned shares on the settlement date. The return on instrument X behaves in a way similar to equity instruments as it is linked to the share price of Company A. But it requires a cash payment, which means instrument X would be classified as a financial liability. Income and expenses on financial liabilities, such as fair value gains or losses, would be recognized in profit or loss. So what happens if Company A isn't doing so well? It is likely that its share price will fall. In turn, the amount of cash payable on instrument X would decrease, and that cash payable amount decreased, Company A records a gain on that instrument. Some might view that this is a counterintuitive reporting outcome. As Company A performs poorly, it records a gain, boosting its net profit, and if Company A performs well, it would be recording a loss. In view of this, the board developed presentation requirements to enable users of financial statements to distinguish this type of income and expenses separately from other types. In the board's view, such separate presentation would help users assess the entity's financial performance better. So what kind of instruments would have the reporting consequences similar to those we just looked at in the previous slide? The board identified three types of financial instruments that would share similar consequences because the amount of these financial instruments is affected by changes in the entity's available economic resources. They are 1. Non-derivative financial liabilities that contain no obligation for an amount independent of the entity's available economic resources, such as instrument X we just looked at in the previous slide. 2. Derivatives classified as financial assets or liabilities that have a net amount unaffected by any independent variable. For example, a net cash settled derivative to deliver a fixed number of owned shares for receiving a fixed amount of cash in the entity's functional currency. Finally, partly independent derivatives, that is, derivatives that are affected by both independent and dependent variables. Income and expenses from such a derivative would include the effect of changes in the entity's available economic resources, as well as the effect of other independent variables. The board's proposal in the discussion paper is that separate presentation would apply to particular foreign currency derivatives that are partly independent. The only independent variable should be the foreign currency variable, and in addition, the derivative would need to meet specific criteria for separate presentation to apply. In other words, if a partly independent derivative were affected by any other independent variable, separate presentation would not apply. We will discuss the criteria later in this webcast. Now I'll hand over to Uni to take us through the rest of the webcast.
Thanks, Kumar. Okay, let's now look at how separate presentation would work. The board's proposal is that if a financial instrument is within the scope of separate presentation requirements, income and expenses from all such instruments are presented in other comprehensive income without subsequent recycling to profit or loss. In this way, users of financial statements could distinguish income and expenses from financial instrument with equity-like returns from income and expenses from other financial liabilities and derivative assets and liabilities. In other words, income and expenses from financial liabilities and derivative assets and liability that behaves in a similar way to the return on equity instruments will not be recorded as part of the entity's profit or loss. Let's consider an example of a derivative that is not affected by any independent variable and consider how separate presentation requirements would apply. Let's say an entity writes a call option on shares. If the holder exercises the option, the entity will deliver in cash the difference between the fair value of 5 own shares and currency unit 100. This option would be classified as a derivative liability because the instruments contain an obligation to deliver cash at a specified time other than at liquidation. But the net amount of the option is unaffected by any independent variable. That is, its income and expenses are driven by changes in the entity's available economic resources. Applying the separate presentation requirements, the entity would present total income and expenses in respect of this option in other comprehensive income. Now that we have looked at how separate presentation works for a derivative with the net amount that is not affected by any independent variable, we would like to discuss how the criteria-based approach would apply to separate presentation of partly independent derivatives. Let's consider another example. And this example is a partly independent derivative, and consider how separate presentation requirements would apply. Let's say an entity writes a call option on shares. If exercised by the holder, the entity will deliver 5 own shares and receive cash in foreign currency unit 100. This instrument would be classified as a derivative liability because its net amount is affected by an independent variable, foreign currency. But its income and expenses would include the effect of changes in the entity's available economic resources. Applying the separate presentation requirements, the entity would assess whether this partly independent derivative meets the specific criteria. If so, the entity would present total income and expenses in respect of this call option in other comprehensive income. To sum up, the board's proposal is that separate presentation requirements would apply to all these 3 types of financial instrument. For non-derivative financial liabilities, the separate presentation requirements apply to those that contain no contractual obligation for an amount independent of the entity's available economic resources. For derivatives on equity, the separate presentation requirements would apply either if the net amount is not affected by any variable independent of the entity's available economic resources, or if a derivative is partly independent and meets all of the specified criteria. In the discussion paper, we also cover an approach the board considered as an alternative to the criteria-based approach. It is called a disaggregation approach because it involves disaggregating income and expenses from a single financial instrument into two portions. If the disaggregation approach were applied to partly independent derivatives, the presentation outcome would be different from what it would be under the criteria-based approach. So let's compare them. Consider the same derivative we have looked at on previous slide. An entity writes a call option on shares. If exercised by the holder, the entity will deliver 5 on shares and receive cash in foreign currency unit 100. Assuming the total income on the call option for the period comes from a fair value gain of currency unit 10. Applying the criteria-based approach, the entire currency unit 10 would be presented in other comprehensive income. Applying the disaggregation approach, on the other hand, the fair value gain of currency unit 10 would be split into two portions. The independent portion, currency unit 3 in this example, that represent the effect of the independent variable, and the dependent portion, currency unit 7, which represents the effect of changes in the entity's available economic resources. The two portions will be reported as part of the net profit and as other comprehensive income, respectively. The board's preliminary view is that the criteria-based approach is the preferred option, mainly because of the anticipated complexity and the cost of applying the disaggregation approach. There is one decision related to presentation of financial liabilities on which the board did not reach a preliminary view. This decision relates to hybrid instruments that contain an embedded derivative. That is, whether the separate presentation requirements should still apply if the entity chooses the fair value option and designate the entire hybrid contract to be measured at fair value through profit or loss. Two alternatives were considered and no decision was made. Why don't we work through these two alternatives with an example? Let's say an entity issues a foreign currency convertible bond. If the entity had chosen to separate the embedded conversion option, that is denominated in a foreign currency, the entity would assess whether the option meets the specific criteria, and if it does, would present the income and expenses from that conversion option in other comprehensive income. But what if the company chooses to elect the fair value option and measure the whole foreign currency convertible bond at fair value through profit or loss? Should the entity still be required to separate income and expenses from the conversion option and present them in other comprehensive income? Alternative A on the left side would be to apply separate presentation only to those embedded derivatives the entity had chosen to separate from the host contract. Alternative B, on the other hand, would be to apply the same separate presentation requirements to all embedded derivatives, even if the entity would have elected to measure the entire hybrid contract as a whole at fair value through profit or loss. The board considered that alternative B would have the benefits of providing more comparable information across all embedded derivatives, regardless of the entity electing the fair value option or not. However, the board also recognizes alternative B would be more costly to implement. Therefore, the board decided to seek feedback through the discussion paper before forming a view. So far, we have been focusing on separate presentation of income and expenses. But what about presentation in the statement of financial position? The board's proposal is to use separate line items on the face of statement of financial position. It means a breakdown will be provided for relevant line item. For example, derivative financial liability and non-derivative financial liabilities could be broken down into those that have the amount feature independent of the entity's available economic resources and those that do not. In this way, users will be able to distinguish these different types of financial liabilities and derivatives assets and liabilities from the statement of financial position. Back to you, Kumar.
Thanks, Yumi. This slide summarizes the board's preliminary views on presentation of financial liabilities and the alternatives considered. The preliminary views are shown in the solid blue text boxes, whereas the alternatives considered but rejected are shown in the boxes with the dotted lines. As a recap, the objective of separate presentation is to facilitate the two users' assessments. One of them is assessment of whether an entity has sufficient economic resources required to meet its obligation at a point in time, and second, whether the entity has produced a sufficient return on its economic resources to satisfy the return that its claims oblige it to achieve. In the discussion paper, we refer to it as assessment of balance sheet solvency and return. In this webcast, we covered presentation requirements that are aimed at facilitating this assessment, as you can see on this slide. The board also considered whether presentation requirements should be developed to provide information to facilitate the assessment of funding, liquidity, and cash flows, but decided not to do so. That assessment looks at whether an entity will have the economic resources required to meet its obligation as and when they fall due. In the board's view, the existing disclosures such as current and non-current presentation requirements in IAS 1 and maturity analysis requirements in IFRS 7 are sufficient for this purpose. This brings us to the end of our final webcast on the series. Thank you all for listening, and I hope you have found it useful. Thank you.